Hi, folks. If you can hear me, just you can either type it in or just tell me you can. So it'll be good.
Yeah, can hear you.
Good, perfect. Give it another minute or so for people to join in. Yeah, if you have any questions, kind of ahead of the class, you're welcome to kind of raise them now.
Question about Monday's quiz.
Yeah.
Do we have to start the quiz by 1 p.m. or 2
Yeah.
p.m.?
I think 1 p.m. because I think the quiz has to be turned in by 2 and it's a 1 hour quiz. Most of you won't take an hour, but I would start by 1. The reason being I want to have class from 2 to 2:50 because that's what I would normally do in a regular class. So it'll be I've opened it up from 5. I think I will open it up at 5 a.m. New York time to 2 p.m. That way, wherever you are in whichever time zone, there should be about 9 hours that you have to take the quiz. It'll be a 1 hour quiz. If you are one, I think there are a couple of people who are in the Moses Center. I have your names. I will add on the extra time if you have the extra time. But the way it'll work is when you get on, I'll actually send you a demo quiz tomorrow so you get a sense of how it works so you're not struggling on Monday. The demo quiz is like a 5-minute quiz so you can see just the process. So don't expect the demo quiz to be about valuation. It'll be questions like, is the sky blue, green, yellow? So basically you can just take the questions quickly and see how it works so that you get comfortable with an online quiz if you've never taken one. But it will be online, it'll be multiple choice. The grades will go up almost instantaneously because the computer grades much faster than I do. But I will hold off on the grades being released until everybody's taken the quiz. Probably by that evening, you should be able to check your grade in the grade book in NYU classes.
Actually, about the quiz.
Yeah.
Is the quiz cumulative?
It's not, but it's kind of a lie, right? Because if you don't quite understand how to get betas and cost of capital, how the heck can you do DCF? So it's not cumulative. I will not ask you a bottom-up beta question like I did in the first quiz, but I can assume you know how to lever and unlever betas because that's part of DCF. So it's non-cumulative. But
Okay.
if you're shaky on the quiz 1 material, I'll go back and review that.
Okay, and we have to look at the exams anyway, so that will give us a fair idea of how.
Yeah, take the last. It'll be exactly like the past quiz does. The only difference is it'll be open-ended. It'll be 5 multiple choice questions.
Right. Thanks so much.
Yeah, I wanted to ask for previous questions, the way that you graded, or rather for previous quizzes, it would be possible to not get the right bottom line answer, but still get partial credit.
No partial credit. Nope, computers don't. That's why first I broke it down into 5 questions. So you mess up, you lose only 2 points. So there will be no partial credit, unfortunately. So I'm trying to work on getting them to give me enough flexibility so I can say 1B is the perfect answer. 1A is close, but they don't have the capacity yet. Okay, welcome, and I hope you're all well. So today I'm going to continue with what I started last session, where I started valuing Amazon. And are there any questions on valuing young companies? Because as you can see, valuing young companies requires some creative thinking, some imagination. I think it's kind of fun, but a lot of people get uncomfortable when they have to do that. But you have to be willing to do that. So what I'd like to do now is actually take you back to the table that I left you with last session, where I compared my predictions in 2000 for Amazon to the actual numbers that came in for those 10 years. And I said what happened was over the 10 years, here's what Amazon showed me they could do, that they could grow faster than I thought they would. Their revenues, especially as you get to 2009, 10, 11, are going well above what I thought they would. But take a look at the margin. There's a very interesting story developing with Amazon if you look at the last column. Notice initially they're behaving like most young companies do. As they mature, the margins are going from negative towards a positive number. Until about 2007, I think, is when they start to suddenly deviate. And what you notice as you get past 2005, 2006 is the margins start to go down again. Okay. So what's happening here is instead of maturing as a company and becoming a larger revenue, high margin company, it's almost as if Amazon is going back to being a young startup again. And that's exactly what they did. In a sense, what they did in 2009, 10, 11 is they were setting themselves up for another phase of growth. Very few companies have succeeded in doing this. But essentially, Amazon was entering the entertainment business. It was investing much more heavily in Amazon Prime. And towards the end of the period, it was starting its investment in the cloud. So I'm going to show you my 2018 valuation of Amazon because in a sense, as Amazon has evolved over time, it's changed as a company. I'm sorry. In 2018, this was September of 2018, I valued Amazon again. And I said, it's not an online retail company. In fact, one of the most interesting surveys I've ever seen asked 50 companies in a wide range of sectors, who their 5 biggest potential competitors would be going forward. 50 very different companies ranging from JP Morgan all the way to Walmart. They're asked, who are your 5 biggest competitors? 47 out of the 50 had Amazon on their list. Walmart obviously had Amazon on their list. I think Amazon lives in Walmart's head. There's no decision that Walmart makes that's really about Walmart anymore. It's about Amazon. It lives in the it lives in the heads of FedEx and UPS, logistics businesses. Disney and Netflix worry about Amazon. JP Morgan is worried about Amazon, Amazon Bank. So in 2018, when I valued Amazon, I changed my story. As I said, I have absolutely no qualms about changing my story based on the numbers. And looking at what Amazon had been doing for the previous 7 or 8 years, I said Amazon is not a retail company, it's a disruption machine. Let me explain what I mean. Disruption machine in the sense that it can look at any business that we can invade that business. Look at the grocery business, right? Until a few years ago, Amazon was not there, then they bought Whole Foods. The day Amazon entered the grocery business, the collective market caps of grocery companies, Walmart, Target, Kroger's, collectively dropped $35 billion. One of the things Amazon seems to do is whatever business they go into, they ruin the business for everybody else, even if they haven't figured out how to make money. So I call them a disruption machine, which in a sense expands my story, right? Because now they can be in pretty much any business with an army. Who's Amazon's army? Amazon Prime. You have 110 million Prime members. You can essentially turn them loose in any business. If you enter the banking business, Amazon Bank, the first persons who are going to get an email are people like me on Amazon Prime saying, would you be interested in Amazon banking? And boy, would I. So when I revalued Amazon in September 2018, I gave them revenue growth that I would not have given them as an online company. So if you look at my expected revenues for Amazon, I'm projecting revenues of $626 billion 10 years out. Now, how many companies have revenues of $626 billion right now? Not one. I am making Amazon the largest company on the face of the earth in terms of revenues. So that's the first part of my story. And my justification is, hey, they're not just in retail, they could be everywhere. I'm assuming over time their margins will move towards 12.5%, partly because their margins have been improving. The cloud business is contributing a great deal. But I think they're going to hit a cap. Why? Because you're in multiple businesses, your margins are going to start to converge towards the margins across the entire market. Taxes, I'm going to assume that they will start moving towards a 24% tax rate. That was the September 2018, my estimate of what the tax rate would be. And if you look at reinvestment, they're continuing to reinvest because they're continuing to find new businesses to disrupt. So here's the bottom line. This is a pretty big story, a very optimistic story about Amazon becoming a disruption machine with a disruption army. The value that I got for Amazon as a company in September of 2018 was about $1,250. Stock was trading at $1,970. Even with a really big story, I'm having a really difficult time getting above $1,250. Now you could ask me, how certain do you feel about the valuation? My response is going to be, are you kidding me? Certain is not a word I would use here. There are lots of pieces to the story. I could be wrong about every one of them. So I'm going to introduce a technique that I've talked about. Those of you in my corporate finance class have seen this, but this is one of my favorite tools now. It's called a Monte Carlo simulation. You know what a Monte Carlo simulation is? See these assumptions I'm making about revenue growth, margins, tax rates, reinvestment. When I do a discounted cash flow valuation, I make what I call point estimates. I give you one number. And part of me is screaming, but I could be wrong. I could be wrong. In a Monte Carlo simulation, here's what I do. Instead of giving you one number, I give you a distribution. Let's take the revenue growth rate. In my base case, I'd use a revenue growth rate of 15%, right? Well, I could be wrong. The revenue growth rate could be lower, 5%, or it could be higher, 25%. I've made it a uniform distribution. In other words, it can be anywhere from 5 to 25%. I'm incredibly uncertain about revenue growth, but my expected revenue growth is still 15%. I now have a distribution. On the operating margin, my base case was 12.5%, but I could be wrong on that. And the way I captured that was I made it a normal distribution where margins could be much higher, 15, 16% or much lower. For the sales to invested capital, I used a 5.95 as my base case because I assumed they could efficiently grow. There again, I could undershoot or overshoot, again around the same expected value. And for the cost of capital, my expected value was 7.97%, but I made it a distribution with a longer right tail. It's much more likely to be higher than lower. That's called a right skewed distribution. Normal, uniform, triangular, and this is a log normal distribution. If every distribution I described there, other than the normal distribution, sounds foreign, you don't even remember hearing about the distribution, I blame your statistics professors. Because let's face it, after every statistics class, what's your reaction? Thank God that was over. I hope I never see it again. Much of what you need for Monte Carlo simulation should have been taught in your statistics class about different kinds of distributions. At the end of today's class, I will send you a 12-page paper I have on how to pick distributions. It's very short and very to the point because in a Monte Carlo simulation, it's garbage in, garbage out. If you just pick random distributions, you make everything normally distributed, you'll get great looking output, but it'll be garbage out. So you have to think through those distributions. I built the distributions around the same expected values. And in a Monte Carlo simulation, here's what happens. The computer goes and picks one outcome of each distribution, good or bad, and comes up with a value. And it does it over and over and over again. I did 100,000 simulations. Sounds like I was working a lot, right? But I'll give you a very simple way these distributions get done almost effortlessly. I got a distribution of values for Amazon. You're saying, what the heck am I going to do with it? See the median value that I got, 1,242? That is very close to the 1,255 that I got in my base case. And that shouldn't surprise you. All of my distributions were built around the same base values that I used in my base case. So I'm getting pretty close to the same expected value. Saying, why did we waste our time then? I also get the 10th, the 20th, the 30th, the 40th percentile, all the way up to highest and lowest values. Best case, worst case are right there. But let's ask a question. The stock is trading at 1,950. Is it possible that Amazon could be worth 1,950? Obviously. I mean, look at the distribution. It's around the 83rd or the 84th percentile of the distribution. There's a 16% chance it's undervalued and 86% chance it's overvalued. I've always described investing as a game of odds. And to me, at 1,950, I cannot rule out the possibility that Amazon is undervalued, but the odds clearly are not in its favor. So for the first time in my life, I told you last class, I bought Amazon 4 times, I sold Amazon 4 times. The 4th time around, I sold first and bought back later. I sold short at 1,950. You remember when January 2000 I was unwilling to do that? The reason I was willing to do that is now the game seems to have changed. I can sell short for a longer period. Amazon is one of the more liquid stocks in the market. I sold short at 1,950. You know what the next thing I did was? I got down on my knees and said, please God, don't punish me for selling short on Amazon, because people have paid with their shirts for selling short on this stock. At the same time that I sold short, I put in a limit order to cover if the stock hit 1,400. You're saying, why 1,400? That would make it go to the 60th percentile, which would make it close enough that it's fairly valued. You know what? I got incredibly lucky on this bet. Because in the next 3 months, Amazon melted down to 1,320. My sell kicked in at 1,400. I collected my profits and I said, thank God I got lucky. It wasn't brilliance, it wasn't my valuation that did it. But one of the things that comes out of a simulation is not only do you get a sense of when to buy, but when to sell, because you get the distribution. Now, 50 years ago, doing this would have cost you a lot of money and a lot of time. I used a program called Crystal Ball. There's also a program called At Risk. It's an add-on to Excel. Now, there are ways you can build this into Excel, use R to do it, but I just want a simple, low learning curve program. Crystal Ball does that for me. What Crystal Ball does is it turns any Excel spreadsheet into a Monte Carlo simulation. Any number you enter as a single number, you can enter as a distribution. And it allows you to take, remember the DCF you've sent me, or you're planning to send me? You can add Crystal Ball on top of it and make it into a simulation. And some of you might be aware, but Stern actually allows you access to Crystal Ball. You can download it and try it out. It's a very low learning curve. Give it a shot and read that 12-page paper I sent you on distributions. And you'll be amazed at how nicely you can convert a base case DCF into a Monte Carlo simulation. Any questions on this Monte Carlo simulation? Rami has a question about it being flat. That's called a uniform distribution. If you're completely fuzzy about the future, you say, well, I think it'd be anywhere from 5 to 25, but I don't know where. You can use a uniform distribution, same probability for every value, as opposed to peak distributions, like the normal distribution or the uniform distribution, where I think there's a central value and the other values are less likely. One of the questions Alex said is how the stories tied together. That's actually a very good point, because one of the great things about Crystal Ball is it actually allows you to build correlations across the distributions. Let me explain. Let's assume that one way you can get high revenue growth is by lowering margins, right? By selling at a lower price. Their revenue growth and margins will be negatively correlated. In other words, the outcomes where you get high revenue growth will be the ones with low margins. So you can build a negative correlation, you can build in positive correlations. You can actually take your story and actually convert it into not just distributions of the variables, but how they move together. No, the distribution you've got to give it. How can it be generated by the model? I mean, the model is no memory, so you've got to give it. So you can either base the distribution on historical data for the company. In Amazon, I have 22 years of data. Or on cross-sectional data. You know what I mean by cross-sectional data? I have the margins for every, let's say this was a retail company. Amazon's more messy, but let's say it's a retail company. I have the margins for every retail company, 250 of them. I can put into a distribution and use that as the basis for picking the right distribution for my company. So use historical data, use cross-sectional data, make your best judgments, and essentially, and if you want to work out the correlations, if you have the data on the past, let's say one of the variables you want to look at is T-bond rate, right now 0.85%. Let's say you want to make it into a distribution, but you think it's going to be related to the risk premium. If you go to my website, you have T-bond rates and risk premiums every year. You can work out the correlation and use that as the basis for building a simulation. So give it a shot. It's really not as complicated as it looks, and it's a fun tool to use. I really enjoy using it. Okay, so let's move on to the second aspect of the dark side. Let's talk about valuing mature companies. Normally, when you value mature companies, your life gets easy, right? You get a lot of history and they have an established business model. So these are the companies that usually give us the least trouble. But if you're a mature company, you've been doing the same thing over and over for the last 50 years, you sometimes get into bad habits. You take investments because you've always taken them. You open stores because that's what you've always done. But the game is not working anymore. That's when you get pushback from investors saying, maybe you should rethink your business model. This often takes the form of not you and I putting pressure, but a guy like Carl Icahn or Bill Ackman putting pressure on the company. So when you have mature companies that are being pushed to change, you face a challenge. And here's what the challenge is. Think about the 4 questions you ask about a company. What are your cash flows? What's the value of growth? How risky are you? When will you become a mature firm? Now think about 2 ways you can answer the question. One is you can take the status quo and just tell me what you've always done. You say, look, my cash flows are this is how I invest, this is the value of my growth, this is how risky I am, and this is when I'll become a mature company. That's one set of answers. Or you can say, look, maybe we should do things differently. We can restructure. And if we restructure, this is what our cash flows will be. This is the value of growth. This is how risky we will be. And this is when we will become mature companies. Do you see, for the same company, I can get two very different answers depending on whether I want to keep the status quo or restructure the company. So rather than talk in abstractions, let me use an example. I'm going to value a company called Hormel Foods. This is an old valuation, so take it with a grain of salt. Hormel Foods obviously is a food processing company. It's been around a long time, and it produces all kinds of canned food. Some of it truly disgusting. In fact, do you know what Hormel Foods' most famous product is? Spam. Yeah, the most disgusting food item I think ever concocted by human beings. If you've never seen Spam, don't look at it. Yeah? I remember the first time I saw Spam. It was a can. My wife opened the can and I said, "What the hell is that?" She said, "It's a meat." And I said, "You can can meat and keep it for 100 years?" Because that's what it looked like, the life of it was. And that's what Spam is. You know the history of Spam? How Hormel Foods came up with it? At the end of the Second World War, the US Army was trying to bring its armed forces back from Asia. So they were all trying to fly these tens of thousands of soldiers from Asia back to the US. And at that time, the US Army did not have planes that could make that flight. It was too long a flight. So all the flights had to do, they had to stop in Hawaii because it's halfway between Asia and the US. So here you have hundreds of thousands of hungry soldiers landing in Hawaii. And this is not the Hawaii of today, with grocery stores and malls and and hotels. The Hawaii of 1945, there was no food, not enough food to feed these people. So the army put out an urgent requisition. They said, "We want somebody to come up with meat." Because remember, these weren't vegan soldiers. They wanted meat. But meat that doesn't have to be refrigerated. And Hormel came up with Spam. That's why if you go to Hawaii, still you can get cookbooks built around Spam. Spam casserole, stir-fry Spam, it's disgusting no matter how you make it. But they've discovered 200 different ways of using Spam in different dishes. So that's the history of Spam. Hormel's been around a long time. It's been a profitable company for a long time, but it's set in its ways. So here's what I did. I first valued Hormel as is. It's run by a very conservative management team which refused to invest outside the US. They had a low reinvestment rate. So that's the first thing to notice. 19% reinvestment rate. They had decent returns on capital, 14.34%. But because they reinvested so little, they had a low growth rate. They were also very conservative about borrowing. They had about 10% debt, 90% equity. So their cost to capital reflected that. So initially, here's what I did. I valued Hormel with only 3 years of growth and a very low growth rate at that. And I came up with a value of about $32 per share. That's my status quo value. Then I valued it again, assuming a more aggressive management ran it. And what will the more aggressive management do? I started a disadvantage here. I really don't know much about food processing companies. So I said, hey, this more aggressive management will grow, primarily by growing outside the US. It'll have to accept a lower return on capital, but that higher reinvestment rate, even with a lower return on capital, gives me a higher growth rate. So the more aggressive management will grow the firm at a higher rate and for a slightly longer period, 5 years. I also assumed that the more aggressive management would use debt more aggressively in the capital structure. I moved that debt ratio to 40%. Why 40%? Well, that was their optimal. And if you remember the corporate finance class, you know what the optimal is. It's where the cost of capital is minimized. I'll come and back it up. For those of you who are not in my corporate finance class, I'll talk about how I came up with the optimal. So lower cost of capital, higher growth. I revalued the company with those assumptions and I get a value per share of 38. So I have two values, a status quo value, 32, and let's call it a restructured value of 38. You're saying, which one should I use? As an investor, you don't know where they're going to end up. Maybe they'll end up in the status quo, maybe they'll restructure. So I had to make a judgment on what the chances were that this company would be run differently. So somebody's got to change the management, right? So I took a look at who the shareholders in Hormel were, hoping for a Carl Icahn and a Bill Ackman on the list, but neither was there. In fact, the largest single shareholder in Hormel was the Hormel Foundation. The Hormel as a company was founded by the Hormel family. And the Hormel family is long since passed on. They've given up control of the company technically, but their shares are held by a foundation. And the foundation votes their shares. So I said, maybe the foundation is run by somebody who can put pressure on the company. So I took a look at the foundation's board, and the chairman of the board of the Hormel Foundation was the CEO of Hormel. That's stomach drop. There's no way he's going to put pressure on himself. So I attached a very small checks, 10%, that there will be change. You're saying, why are you even putting it 10%? Because Hershey, which used to be structured exactly like Hormel, eventually even the foundation put pressure on the company. So there's hope, but there's very little hope. 10% chance of change. My expected value for Hormel, if you look to the right, is 10% times 38 plus 90% times 32. That expected value is what I'll compare the stock price to. You see how that value could change? If tomorrow Carl Icahn took a position in Hormel, that probability of change jumped from 10% to 30%. That is one reason why when activist investors take positions in companies, you see the price jump. It's the chance of changes increase, and on an expected value basis, you as an investor benefit. Any questions on the Hormel valuation? So now let's take this mature company restructuring. Let's look for lessons, because in every one of these, I'm looking for lessons I can use in other valuations. Some of you are valuing mature companies, and some of these mature companies have come out with plans on how they plan to cut costs over the next 3 or 5 years. I've seen AT&T repeatedly over the last 20 years come out with these 5-year plans where they plan to cut costs. But 5 years later, you look back and you look at what costs they cut. There's no resemblance between what they told me they would cut and what they actually cut. What I'm trying to say in a long-winded way is often companies announce plans, but they don't carry through on it. So one of the things I looked at is, when can I trust a company to cut costs? So I found a McKinsey paper that looked at companies that plan to cut costs and what had to be true for costs to be actually cut. So this is a very fuzzy, subjective paper. The first and most important variable they found in when companies carry through on their plans is, do top managers support these cost cuts? If they don't, there's almost no chance a cost cut's going to go through. Are there clear targets? Are they telling you where they're going to cut costs, or just telling you $3 billion in cost cuts? Is there a plan? Are they telling you what they're going to shut 3 stores every month or 13 stores every year? Do they have the capacity to cut costs? Is there sufficient accountability? At the end of every year, are they required to come out and say, we told you we'd cut $1 billion, we cut $900 million? And is there enough fact for you to make the judgment that you can actually cut costs? What are you going to get out of this particular table? Not much but fuzziness. But all I'm saying is some companies you can trust with cost cuts and plans more than others. And it's worth looking at what backs them up. Second, many mature companies think their problem is they're not growing fast enough. So many of them have low growth rates. Why are they mature? They think the solution is to go back to high growth. So they try everything. They do acquisitions. They take more investments. And this is, of course, a table you've seen in different formats before, where I look at the percentage of companies globally that earn more than their cost of capital, less than their cost of capital, and about their cost of capital. And if you look at the graph, you can see that a significant percentage of companies, 40-50% of companies, when they grow, actually destroy value. So when you have a mature company say, shouldn't I go for more growth? What's the first thing you need to check? You need to check that their returns on capital are higher than the cost of capital. You can grow and destroy value. And maybe for these mature companies, the better solution is for them to shrink. Nobody wants to hear that. But as a mature company, your path to higher value might be to make yourself smaller. And finally, I used a 40% debt ratio for Hormel. And I said it was the optimal. You say, how do you know? This is something we do in our corporate finance classes. If you've taken the class, if you've forgotten, go back and review it, where we look at what will happen to the cost of capital of a company as the debt ratio changes. So remember the process? As the debt ratio goes up, my beta goes up. Why does it go up? Because it's a levered beta. Higher debt ratios, higher debt to equity ratio, higher beta. Higher beta translates into higher cost of equity. As my debt ratio goes up, my cost of equity will always go up. There are no exceptions. Then I estimated a rating at every debt ratio. Saying, how do you estimate a rating? I use the interest coverage ratio at every debt ratio. And remember, as you borrow more money, you have more interest expenses. As you have more interest expenses, the coverage ratio decreases. I get a synthetic rating. So as I borrow more money, my cost of debt goes up. Again, no surprises. The more debt I have, the riskier I am. My cost of debt has to go up. Then I keep track of the tax rate. It's 40%, 40%, and then it falls off the cliff once I get to 80% debt. Does anybody remember from the corporate finance class why the tax rate decreases at very high debt ratios? What's happening when you get to 80 or 90% debt? That's making debt less attractive. You can no longer save on interest expenses. Exactly. The entire tax benefit of debt requires that you have operating income to cover the interest expenses. Your ratings will always go down. That's not the issue. The tax rate starts to go down because of the fact that you no longer have enough income to cover the interest expenses. You're losing money. So your cost of debt increases as your debt ratio goes up. So your cost of equity goes up, your cost of debt goes up. You're saying, this is terrible. Take a look at what happens to your cost of capital. Initially, as you borrow money, it decreases. It keeps decreasing. Somewhere between 30 and 40%, it hits a bottom, and then it starts to go up again. That's why I have to stop at 40. Often when you see people change debt ratios, they will just change the debt ratios and leave the cost of equity and the cost of debt as is. You cannot do that. Now, James has a question about a company like Hertz, where 3G advocated that they get rid of their unprofitable business segments. You know what? Activist investors have to be taken with a grain of salt. Some of them, they're one-trick ponies. They cut businesses, give me the cash back and a buyback, and let's move on. Now, in the case of Hertz, if in fact those businesses are not just money losing, but you expect them to stay money losing forever, you should shut them down. But if you have a plan where these money losing businesses are going to become profitable, you need to show that plan and counter the activist investor. So it's true you want to think about, so later on in this class, we'll talk more explicitly about what businesses to shut down, what to expand. It's a little more nuanced than just shutting down bad businesses, but that's what you're trying to do, is make your company a more valuable company.
Professor?
Yes.
My question actually was about Heinz. So for 3G, Heinz was really promoting reducing margins and cost savings.
Not reducing margins, reducing costs and increasing margins. Yeah.
Yes, and increasing margins.
Yeah.
So you're essentially saying that it's not black and white as
Exactly. Now, and I'll give you an example. Often, let's say you're Heinz and you have a new startup version where you're delivering, I don't know, cans online, and you decided that this is going to be a great business. In the first few years when you start a business, what are your numbers going to look like? They're going to look terrible, right? So if somebody comes in and says, look, your return on capital on that business is negative, shut it down. That could be if Amazon shut down Amazon Prime because it wasn't making money, there would be no Amazon Prime today. If they looked at cloud in 2013 and said, money losing business, let's shut it down, there'd be no cloud today. So I'm saying it's a little more nuanced. You can't just say business is money losing, it's a bad business. It requires a little more thinking through. And shutting it down might not get you your money back. In fact, it will not get you your money back. So that might not even be the best option, even if it's a bad business. So we'll come back and talk about it more explicitly, because it does require a little more, it requires a scalpel, not a carving knife. And unfortunately, most activist investors don't even know what a scalpel looks like. It's chainsaws for them. Everything is, just chop that off.
Thank you.
Yeah. Okay, no other questions? Now let's talk about the third stage in the life cycle. These are companies in decline and distress. Remember the life cycle, right? You have your young growth companies, you have, peak of your life companies, and your mature companies, then you get older and now you're in decline. Let's see why declining companies are so depressing to value. First question you ask is, how are my numbers looking? And they show you their last 10 years of operating statements. You know what you see? Shrinking revenues, not growing revenues, shrinking revenues, and your margins are getting smaller every year. So your revenue shrinking, your margins under pressure. You're saying that's not good. What's the value of your future growth? They start laughing. What future growth? Because for them, the future looks like you have to shrink even further. So the value of growth here is basically to get smaller. So that question becomes a dead end. Then you ask, how risky are you? Well, this is a business in evolution, right? They're shrinking, they're selling businesses, they're getting smaller. As they get smaller, their business profile is changing, the leverage is changing. They might even, if they're not careful, get into real trouble and not be able to make their debt payments. And finally, you ask, when will you be a mature company? They say that was 10 years ago. That's in our past. That's like asking a 75-year-old, when will you be at the peak of your life? It's not in the future, it was in the past. So already you can see when you value declining or distressed companies, you're going to face issues you don't face with nice, healthy companies. Here's the first one, and it's a psychological one. Let me ask you a question, if you know, and this is not just about this class, but in general. If you valued companies in the past, when was the last time you did a valuation where your revenue growth was negative for the next 5 years? Think about it. Most people, even people who do valuations on a daily basis, you'd be amazed at how often I ask this question and they say, I've never had a negative revenue growth rate in a valuation. What does that tell you? We're in denial. We do know that companies shrink. How come we never seem to run into these companies when we do valuation? So the first thing you face is this psychological barrier to overcome, which is companies can shrink. Your revenue growth rate can actually be negative. Your margins can shrink. And if your company is run by good managers, they realize they're a shrinking company in a bad business. So you know what they do? They don't fight it. They make themselves smaller and they try to make a core of the business perhaps profitable and survive as a smaller business. But God help you if your company is run by managers in denial. You know what I mean by denial? They don't accept the fact that they're a declining company in a bad business. They try to grow. Think Marissa Mayer at Yahoo in 2012. Spending $1 billion to buy Tumblr. Why are you doing this? Because somehow, somewhere you believe in reincarnation. If your declining company is run by managers in denial, they can destroy value so quickly that you could wake up to a company that's worth nothing. So when you're valuing a declining company, not only do you have to be realistic, you have to think about who's running the company and whether they're going to be realistic as well. And that's got to be built into the valuation. So let's try a company. So valuation of JCPenney I did in more optimistic days in 2016. I've become even more pessimistic about JCPenney since then. So in 2016, I made my projections, and this is my optimistic story for JCPenney. And if you look at the top line, look at what's happening to revenues, shrinking over time. I'm essentially making JCPenney a much smaller company over the next 10 years because that's the only way I see them surviving is shutting down their most expensive, lowest margin stores and going back to being more of a niche department store. That's an optimistic story. And if that happens, I'm assuming the margins, which had hit rock bottom in 2016, would converge back not even to the level of all retail firms, but maybe the 25th percentile. So in my optimistic story, I'm shrinking JCPenney to a much smaller company, giving it decent but not great margins. And along the way, you'll notice negative reinvestment. You say, what does that even mean? And negative reinvestment basically means you're shrinking as a company. It doesn't even require you to sell off stuff. In this case, I am assuming you shut down stores and you get cash out of some of those leases. It could just be you stop capex, but remember, depreciation keeps going from old investments. You can get negative reinvestment coming from the fact that you've stopped investing, but you're still getting cash flows from past investments. So I've got my free cash flow to the firm reflecting my story, and it's not a great story. You can see the cash flows kind of peak in year 4 and then decline over time. At the end of year 10, I attach another optimistic spin. I assume the company can stay on as a smaller niche business. That's what the terminal value is. I discount it back. I do have to be realistic and recognize that this is a company that could go under, so I attach a probability of failure. Very similar to what I did with young companies. It's amazing how young companies and really old companies require some of the same techniques. I get an expected value of 4.4 billion. So the story I'm telling for JCPenney is of a shrinking company that eventually becomes a niche business. Hey, you could take the same story and make it more pessimistic. You can say, look, this is a company on its way to nowhere. So the end of year 10, I'm not going to allow it to continue forever. I'm going to assume a liquidation value. So you'd replace the terminal value with a liquidation value, which might be just liquidating those leases they have, selling off whatever assets they have, and might be only $1 billion salvage value. And that would then be a value for a company. So with declining companies, be willing. No, go beyond be willing. Be realistic about revenues in the future and what will happen to margins. And if you're able to do that, you should be able to value declining companies. Any questions on declining company valuation? Keenan has a question about what should declining companies do? Can I hold off on that question? Because one of the things I want to come and talk about is restructuring in general, because I think there's a lot of cookbook restructuring that goes on out there. You know what cookbook restructuring is? CEO comes in, what does he do? Sells off the worst businesses, he holds on to the best businesses. We're going to argue that that might not be the best strategy, that your best strategy as a declining company might sometimes be to sell off your best businesses and try to reduce your worst business. You know why? Because when you sell a business, people pay what they perceive that business to be worth. And your best businesses might actually be worth more than your worst businesses relative to what you think it's worth. Now, Julieta asked a question about how you come up with liquidation value. Just use book value. No, I think that's about all you can do. No. My reinvestment assumptions, I use the sales to cap ratio. Same sales to cap ratio, but remember, when my revenues are shrinking, the same sales to cap ratio will give me a negative number. So it's amazing how flexible that sales to capital ratio is dealing with different kinds of companies. If a company is trading for less than book value, so what if it's trading for less than book value? You assume that book value is liquidation value? I don't believe accountants. When something sells for way below book value, it's because that book value is not monetizable. So don't assume that book value is liquidation value. Otherwise, you'd have an investment strategy built around buying stocks that traded below book value, and you should make money. Unfortunately, that doesn't seem to work that well. Any other questions? Now, there's another aspect of decline that is a little more catastrophic, which is as companies decline, if they're not careful and they have a lot of debt, they can run into a problem of distress and not making it. Now, one of the things we almost never talk about when we do intrinsic valuation that we need to be more explicit about is when you do a discounted cash flow valuation, you're valuing a company as a going concern. You know what I mean? Think of how we do DCF. We project out cash flows in year 1, year 2, year 3, year 4. Then we get to year 10. We assume cash flows continue forever. We assume that even if our company has bad years, it'll bounce back and make it to year 10 and beyond. Now, when you're valuing a distressed company, that's an extraordinarily dangerous assumption. Now, I'm going to argue that adjusting the discount rate is not going to do it for you, because that's what people try to do. If I push up the discount rate, when I bring in distress, no. Discount rates were designed to capture continuing risk that your cash flows in year 7 will be different from expectations. Discount rates were not designed to capture what I call truncation risk, the risk your company will not make it. So you know what you have to do? When you do your DCF of a distressed company, you got to put your optimist hat on. That hat that you put for young companies, put it on again. Value a company as if it fixes itself and makes it, come up with a value. You're not done yet. Then ask yourself a question. What is the chance my company will not make it? Notice how similar this is to what I was asking with young companies. And ask yourself, what will my equity be worth if that happens? Your expected value will be that expected value. It will be across those two values. The DCF value times the probability that you will make it, times the distress value for equity, times the probability of distress. You're saying, how the heck am I going to come up with probability of distress? I'm going to give you one way. I think it's very clever, where you can use a corporate bond issued by the company to back out the probability of distress. That you can apply if you have traded bonds and you can actually get the numbers. And for some companies, it works. For most companies, though, if you have a rating, you can actually use it to get a probability of failure. For instance, I value Boeing. And with Boeing right now, even though it's a company with a great history and it's a duopoly, you worry about, will Boeing make it? Here's one way to do it. You know what Boeing's rating is right now? Boeing's rating, I think last week was lowered to BBB. And if you look at the history of BBB rated companies, over a 10-year period, I think 9.5% of BBB rated companies default over that 10-year period. I could value Boeing attaching a 9.5% chance of failure, where I take the rating, assume it's right, and use it. I'm trusting the ratings agency, but what else can I do? And the third is to use all kinds of, we have access to big data now. In fact, we know now how many companies have failed in the last 10 years, and we know the characteristics of those companies. You can use statistics and do what's called a probit. It's like a regression, where you take the characteristics of companies that failed and you build up this prediction model, where you look at existing companies and you look at the debt ratio and how much cash they have and whatever else you think drives failure, and you come up with an expected probability of distress. But there's no way around this. You can't just do a DCF and leave it there, because it's going to give you too high a value for distressed companies. So let me try this on a company. The company I'm going to value is called Las Vegas Spreads. Oh, Julian actually brings up a very interesting point. If you have a credit spread or a CDS, you can actually convert a CDS or credit spread into a probability of default. It's very similar to that first where I use a bond price. So when I do that, I'll talk about it. But you do need a possibility of failure. Okay? So let's talk about how this would work. A company I'm going to value is a company called Las Vegas Sands. Now, Las Vegas Sands is a casino company, and this might be overstating it, but I'm going to say it anyway. Casino companies around the world seem to be run by megalomaniacs. Yeah. Megalomaniacs basically are, when you look at wind resorts. When you look at wind resorts, you have Steve Wynn. When you look at Las Vegas Sands, you have Sheldon Adelson. So there's a reason I'm bringing that up. In the last decade, where I'm in 2000 through 2007, I have to be specific about what the last decade is. Between 2000 and 2007, Las Vegas Sands was one of the fastest growing casino companies in the world. No. So basically what I'm going to do is I'm going to take Las Vegas Sands, and Las Vegas Sands is run by Sheldon Adelson, who owns 50. I'm sorry, where did I lose you?
We can't hear you.
Where did I lose you though? I need to know where I lost you.
Just the last 2 minutes.
From the beginning of Las Vegas Sands.
Okay, let me go back to the beginning of Las Vegas Sands.
Yeah.
So Las Vegas Sands, so the company I'm going to use as my example for this is Las Vegas Sands. Las Vegas Sands its CEO is a guy called Sheldon Adelson, a megalomaniac. Yeah? And between 2000 and 2007, Las Vegas Sands was one of the fastest growing casino companies in the world. It was building casinos in Macau, in Vegas, in Singapore, Marina Bay Sands, some of you might be familiar, huge monstrosities. $500 million, $600 million. And this is where the megalomania comes in. Now, normally, if you're a company growing fast, you can raise money from either equity or debt. Las Vegas Sands borrowed almost every dollar they needed to build these casinos. You know why? Because Sheldon Adelson controlled the company with 52% of the shares. If you issue equity, what might happen? You might lose control. So he borrowed money. And as long as times were good, nobody noticed that the company was building up this huge debt load. Then 2008 hit. The crisis hits. And overnight, the company goes from being this celebrated casino company to a company that potentially could go under. So I'm trying to put the setting on February 2009, which is when I valued the company. Every story I was reading about Las Vegas Sands was talking about the fact that the company might not make it. So I'm reading these stories about it not making it through the next 6 months, huge debt payments coming due. So I decided to value it anyway. So I put my optimist hat on and I fixed the company. You know what I mean by fixing the company? You can take the most distressed, troubled company in the world, and on an Excel spreadsheet, you can fix it. And that's what I did. I improved its margins over time. I reduced the debt ratio. I followed the template for fixing troubled companies. So the margins go up, my income goes up, my debt ratio decreases, the company. By the time I may get it to year 10, I've created a nice, healthy casino company with a big terminal value. And this is all in my spreadsheet. I discount the cash flows back. Notice that even though they're a troubled company, their cost of capital is not through the roof. Again, that's what I mean about cost of capital being blunt instruments. Even if I use a really high cost of debt, it's not enough to push my cost of capital up. So I discount the cash flows. I get a value for the operating assets of $9.8 billion. I add cash. I subtract out the huge debt load. The value that I get for the equity is about $5.3 billion, or about $8.12 per share. So in my discounted cash flow valuation, I'm telling a story of a company that fixes itself over time, becomes a nice, healthy company, and the value that I'm getting is about $8.12. The stock was trading at $4.25. So ask me the question, did I buy the stock, right? I wasn't even tempted, which led to some soul searching. Because if the value is $8 and the stock is $4.25, why wouldn't I buy the stock? And what kept me back was the fact that this $8.12 is the value per share, assuming Sands makes it. And my worry was, what if they don't? So basically, here's what I did. I found a Las Vegas Sands bond. It was a 7-year bond that was trading at a huge discount. Why? Because the bond market knew they were in trouble as well. It was trading at $529. 7-year bond with a $63.75 coupon every year. Now, normally the way we value bonds is we take the promised coupon, 63.75, and the face value, 1,000, and we discount it back at what's called a risk-adjusted discount rate, a default risk-adjusted discount rate. I didn't do that. Instead, here's what I did. I took the promised coupon, 63.75, but converted into an expected coupon. You see, what's an expected coupon? For that promised coupon to be paid, the company's got to be around. So that's the probability that the company will be around. And I do that for every year for the next 7 years. And I'll get the face value back only if the company's around. You see, how do I know what the probability of distress is? You don't, but here's what you know. You know the price, you know the coupon and the face value. And because these are now expected cash flows, they've already adjusted with the default risk, I can discount back at the risk-free rate, which I knew. The only number I don't know is the probability of distress. I solved for it and I came up with 13.5% a year. So basically I'm using the solver function in Excel. So what does that mean? Well, there's a 13.5% chance I won't make it 1 year. If I want them to survive 10 years, you say, what's so magical about 10 years? That's when nirvana is, the terminal value. They have to survive every year for 10 years. The cumulated probability of that is only 23%. That's a depressing number. There's only a 23% chance that Las Vegas Sands will make it as a healthy company. And if they do, they're worth $8.12. The remaining 77% of the time, they're not going to be able to make the debt payments. And if they're not able to make the debt payments, my equity is going to be worth zero. My expected value is a weighted average. I know some of you are worried that I might be double counting risk. If that is your worry, use a healthy casino company's cost of capital to value Las Vegas Sands and do this separately. This is the cleanest way of dealing with distress risk, and essentially it brings in that risk. But if you think it's going to be upfront, remember, if you fail in year 1 or 2, you're never going to get to year 10. So I'm actually assuming that this probability that they will not make it is more upfront than later. That's why I'm adjusting the value today. Because if it doesn't happen in year 8 or 9, I'm in much better shape. So in most companies with distress, it's the near years you worry about. And this is a quick and dirty way of adjusting for that risk. And that's exactly what I do in my DCF spreadsheets now. So in the Boeing valuation, I ask you, what's your chance of failure? And you put that number in. I adjust my expected value today for the chance of failure. And I could make this fancy and estimate it by year. It's both first messy to do and it's really not worth the effort. Just attach a probability of failure, bring it in, and move on. Any questions?
Should investment-grade companies also have this?
Yeah, in a sense, you should do this for every company, right? The only thing is, once your chances of being a going concern are 90, 92, 93, or even 80%, you know what happens? It's easier just to adjust your cost of debt and move on. It's not worth the effort. There's a tipping point where you have to start thinking about this. So most companies, if you gave me Coca-Cola to value, there might be a 1% chance of failure. But it's not worth kind of making it explicit. Every company has a non-zero chance of failure. But the closer you get to zero, the less you care about it. So in the spreadsheet, if you put in a 2% chance of failure, it'll have almost no effect on your value. So think of it as a continuum, right? So as you get closer to zero, you don't have to worry about it as you get further away. And that's why something like crisis changes your thinking on valuation. And that's why it's so critical now when you're valuing companies post-corona that you got to think through this number for your company. And use the rating if you have the rating for the company. I'll give you a lookup table where you have the rating for a company. You can look up the probability that it will not make it. Any other questions?
Isn't the distress rate on the bond different from that?
Yeah, and I'll tell you why. Because
go under and the bond might get full payment if it's secure.
when you do cost of debt, think of how you do it. You act like you make your promised payments. That's what the cost of debt. It's not an expected cost of debt. It's based on the promised payments. So implicit in the use of a cost of debt and a cost of capital is the assumption that you'll be around to make those promised payments. So unfortunately, a cost of debt can never be enough to carry distress risk because a cost of debt is designed for a going concern. That's why cost of capital. I mean, you got to make it infinity just before a company goes under.
I think I didn't put my question right. I
Yeah.
said the probability of default, this 13.54 is for the bond. So
Yeah.
for the company, it would be higher, right? Technically, because bonds are more secure.
No, because if you default on a bond, the company's done. Why would it be higher? You're thinking about a collection of bonds? Because, I mean, this is actually a cumulative property for the company. That's what the bondholder is predicting. You know, because are you thinking about a scenario where
$2
you
billion, $1 billion is debt, $1 billion is equity, and the company goes under and your liquidation is 50%. The bond
no, you don't control it anymore. The bank takes over. It liquidates a company. And the liquidation value, remember, you're not going to get your book value back or your equity value back. That's why when you default, you don't get the full value back. You get a portion of the value. The bank liquidates you. They get whatever they get in the liquidation. And if that liquidation value is less than the debt, they tell the equity investors, sorry, go home. So this is not something you control. Once you default, you've lost control of the game. Rob asked the question, what does a government bailout do? Rob, help me out. Tell me what a government bailout does.
I guess it depends how it's structured,
Okay.
if they're taking equity or if it's some sort of loan that they have to pay.
So if you're an equity investor in Boeing, what would you like the bailout conditions to be? First, would you like debt or equity? Would you like the government to give you debt or equity?
Ideally, a forgivable loan that they don't even
Exactly, a
have to pay.
forgivable loan with no interest payments for the next 10 years. That would be really nice.
That would be nice.
That'll be nice. Because then you get to have your cake and eat it too. Because what have they just done? They've removed that 77% and made it zero or close to zero. And you get to keep the upside.
Yeah.
Government, that's why when I wrote that piece on bailouts, I said, look, bailouts are taxpayers investing in the company. First is government bailouts should be structured as equity, not forgivable loans. Because if you're investing in this company to save it, you deserve a share of the upside. And settling for an 8% interest rate doesn't do that, right? So you need a share of the equity. In extreme cases, you know what a bailout could require? It could require that you wipe out existing equity, saying, if we save the company on the verge of bankruptcy, the existing equity investors should not benefit from the upside at all. They'll actually, that's what they did in GM in 2009. Existing equity investors were wiped out. So bailouts conditions matter a great deal in how you play into valuation. That's why initially I was holding off on the Boeing valuation, because there was talk of a bailout, but wasn't clear what the conditions would be. And in fact, the Boeing CEO came out and said that one of the conditions is that the government wants equity, we don't want the bailout. Let's see how firm he is on that position. But for bailouts, you need to know the details of the bailout.
Professor?
Yep.
What if you had maybe like one or two different ideas of how it could be structured, and then you would run the analysis for each?
Yeah, you could do that. I've just had two, so I have a decision tree with 2 branches, right? You can have a decision tree with 4 branches. In which case, you got to be explicit about each one. And remember to attach probabilities to each branch, because that's the thing that people don't seem to do. They think of it as scenario 1, 2, 3, 4. That's incomplete. If you have 4 scenarios, you need expected values under each one and a probability for each one. Hannah asks, what if the bond market is wrong? Yeah, it could be wrong. Then use just the rating. I mean, any estimate you have for the probability of distress is going to be wrong. The question is, which is least wrong, right? Any other questions? So now let's talk about valuing emerging market companies. Again, let's think about the structure of an emerging market company. I ask you, what are your cash flows from existing assets? What's the value of growth? How risky are you? When will you be a mature company? With emerging market companies, here's what's lurking in the room, no matter which company you value. The country is right behind there, right? Think of valuing a Brazilian company in 2016, 17, 18, pretty much any year. When you value that Brazilian company, the Brazilian government is an uninvited guest in your valuation. Uninvited in what sense? Well, that Brazilian company, even if it's a company like Natura, which is really a well-managed, great company, if the Brazilian government is making the country go off the cliff, Natura is going to be affected as well. So what you have as cash flows, what the value of growth is, how risky you are, and when you will be a mature company has this country risk effect in there. So that's always the issue with emerging market companies. It gets very difficult to focus your attention on the company because you keep getting distracted by what the country is doing. I know this is going to be difficult, but you have to keep your country worries to the side, or perhaps take them off the table if you really want to value an emerging market company. So here's what I'm going to do. I'm going to suggest 4 basic lessons with emerging market companies and illustrate them with numbers. First, country risk is an issue. Absolutely. But when you deal with country risk, again, I'm going to use the same terms I used before. You need a scalpel, not a carving knife. In other words, don't take every Brazilian company and give it the Brazilian country risk premium. Every Indian company and give it the Indian country risk premium. We've kind of done the homework on this already. Because when we valued emerging market companies, we said you cannot take every emerging market company in a country and color it with the same color of risk because they're different degrees of exposure. The way we brought this in was with either a lambda, if you had just a single country that you worried about, or by taking a weighted average country risk premium. So to illustrate, here's a valuation of Embraer that I did maybe 15 years ago. Embraer, of course, is a Brazilian aerospace company, but because it gets so much of its revenues outside Brazil, I captured that by bringing in a lambda. And that lambda, if you remember the way we read lambdas, is a lambda scaled around 1. 1 means you're as risky as the typical Brazilian companies exposed to Brazilian country risk. A lambda 0.27 means you're less exposed to Brazilian country risk. Why? Well, because you get so much of your revenues outside Brazil and you're an aerospace company. I did do my entire valuation in US dollars. That was a currency choice I made. So again, remember that that's a choice you always have. And with that country risk built in, I do get a cost of capital that looks low for a Brazilian company, 7.47% in US dollar terms. But it should be low, because even though Embraer is a Brazilian company, it looks very much like a global aerospace company that through the accident of history happens to be in Brazil. So with country risk, keep it in that risk premium. Don't keep bringing it out of the box every time you do every estimate because it's going to drive you crazy. Bring it into the discount rate, large or small, and then move on to estimating cash flows just like you would any other company. In fact, the value that I got for Embraer when I did this valuation was about it was about $9.53 in US dollar terms. Converted at the exchange rate on May 22nd of 2008, the value was 15.72 reais per share. The stock was actually trading at 17. Just to give you some history, I bought Embraer in 2003. Maybe 2002, the year Lula was running for election because Brazil got hammered. The markets were down. Everybody thought, that Lula was going to nationalize everything. And I bought Embraer at a fraction of this price. So the reason I did this valuation in 2008 was to decide whether to keep Embraer in my portfolio. And after the valuation, I left it in. It's too close to the value. If the value I got was 6 reais or 10 reais and the price was 17, I'd have sold. But I've been doing maintenance valuations of Embraer and it's been, for the most part, in my portfolio. But it's one of those stocks that I focus on in Brazil because it's kind of an outlier. It's a company that's Brazilian but really should be treated more like a global company. Any questions on the country risk issue? So bring it into the discount rate, then let it go. Because, if you keep bringing it into the cash flows, the growth rates, and punishing the company over and over and over again, you're going to punish it multiple times for the same sin.
Professor, does that
Yes.
include, if there's a risk of war or...
Okay, we'll come back to that. Benjamin says a very good call. Remember we talked about truncation risk? If you're worried about nationalization, you're worried about terrorism, you're worried about acts of God, you can't bring that into a DCF. We'll talk about how to do that in a couple of minutes. Flavia asks, how would it change when the government owns part of a company? It's always a mixed blessing when a government owns part of a company. What's the good side of the government owning part of the company?
Don't worry about default.
Less worry about default. Maybe they'll come in and protect subsidies, protection against competition. So you get all the good stuff. What's the bad stuff, the government owning a piece of the company?
You were more exposed to the government, changes and
It's not just that. The government is constantly looking over your shoulder. And if you get a chance, read the post I wrote about Petrobras in 2013 or 14. This is what happens when governments constantly interfere in companies. The reason they interfered in Petrobras is they owned a piece of the company and they owned a golden share. So the downside is some of the things you might want to do as a company, you might not be able to do. So if a government owns a company, it's going to show up in your numbers. It's going to show up in the kind of growth rates you give. It'll also show up in the likelihood of default. So the good side and the bad side will affect it. I'm not sure the net effect is positive. I think the net effect is more often negative than positive.
No, I agree.
Yeah.
And my question was like, how would you change the calculation?
Yeah, I would not.
The lambda?
The discount rate, in fact, my lambda will get higher when the government owns a piece, because even if it's a company like Embraer that gets most of its revenues outside, because it's viewed as being in the public interest, the government owns a piece, they're going to make you do things that tie you more closely to country risk. So your lambda will probably get higher. Your default risk might get lower because the government is viewed as the implicit banker, though with the Brazilian government being the backer. I don't know whether that helps you or hurts you. No. But your decisions on whether to grow or how to grow will be constrained by what the government might bring to the table.
Okay, thank you.
Okay, so let's move on to the second lesson. Currencies should not matter. I've said that before, I'll say it again. When you do your valuation, if you stay currency consistent, you should be able to value a company in Russian rubles and value it in US dollars. And if you do it right, the valuation should be the same. And remember why that is? Currencies bring in effects into both your cash flows and your discount rates. You pick a high inflation currency, it's not just that your discount rate is going to be higher. It is going to be higher, but your cash flows are also going to be higher. So as long as you stay consistent, things are going to work out. So one of the things that you're all facing right now is the T-bond rate is low and keeps getting lower, and before you know it, it might be negative. And some of you might be valuing a company in US dollars with a negative risk-free rate. And we did this earlier, but might as well remind you again. The fact that the risk-free rates turn negative doesn't mean you cannot do DCI. This was my valuation of Heineken in September of 2019. Heineken, of course, Dutch brewer. I value it using euros. What's the big deal about using euros? The risk-free rate was minus 0.5%. I left the risk-free rate at minus 0.5%. It gave me a really low cost of capital for Heineken, 5%. You're saying, this is great. My cost of capital is really low. But that same low risk-free rate sends me messages about future growth. That risk-free rate is low because people are pessimistic about future growth. So when I do my growth rate, even for my high growth period, I use a lower growth rate. And when I get to my terminal value, look at my growth rate, it's minus 0.5%. I actually did this valuation in Europe, and there were a group of Heineken executives in the audience. So when I did the valuation and I put that growth rate forever, you know what they did, right? They said, that's so unfair. You're giving us a negative growth rate forever. And I said, you weren't complaining when I gave you a negative risk-free rate and a low cost of capital. They said, but no, what if we think the growth rate after year 10 will be 2%? Then I said, you got to fix your risk-free rate to make it consistent with that growth rate. What kills people in valuations is if you're inconsistent about what you use as your growth rate forever and your risk-free rate. So even if the T-bond rate is 0.85%, just leave it at 0.85%. Let the growth go to 0.85%. Now, one of the things I do give you in the spreadsheet now, if you feel really uncomfortable using negative growth rates, negative risk-free rates or really low risk-free rates, I give you a chance to reset the risk-free rate after year 10. Try it. Set the risk-free rate to 2% after year 10. I'll give you a higher growth rate, but your value will barely shift. The reason is consistency is what drives valuations. So for the moment, don't worry about the risk-free rate. You have enough stuff to worry about already with your valuation. Worrying about how low the T-bond rate is and the Euro bond rate is negative is just going to get you headaches. It's not going to help you. So any questions about currencies and risk-free rates and how they play out in valuation?
Hi, Professor. In the emerging market companies, let's say, for example, in Embraer, the lambda is 20-something%.
Yeah.
I'm assuming that's based on percent of sales in Brazil versus outside, right?
It's it's affected by it, but if you go back and look at your notes, it's actually a little more messy than that. Yeah, but it's driven by that variable that they get so much of their revenues outside.
What if all of the production is in Brazil? And
it does expose them. In fact, they were getting only about 3% of their revenues outside. If I based it entirely on revenues, their lambda would have been like 0.05. The reason it's 0.27 is because of the fact that the production is in Brazil. Okay. Oliver asks, can terminal GB, it is driven by GDP growth, but that's what the risk-free rate is giving you as that's why a negative risk-free rate is so depressing. It's an expectation of future nominal GDP growth, and if your risk-free rate is negative, that nominal GDP growth is also negative. Yeah. Any other questions? Third lesson. Now, often when you value Asian, Latin American, or even some European companies, or you forget that any company anywhere in the world, sometimes you look at the companies that there's no chance I can change the way this company is run, because you have little or no power. That's a corporate governance problem. So when you value companies with weak corporate governance, you worry more, right? Because you can't change the way the company is run. So I'm going to ask you a question about corporate governance, and this is going to drive what we're going to do in the next few pages. Let's say I've done a discounted cash flow evaluation of a company that I think has really bad corporate governance. Should I discount the value of that company for the fact that it has bad corporate governance? No. Should I discount the value? Go ahead.
No,
Why?
because I'm assuming it's already factored in the growth rates and the return.
Who did the
and
DCF?
the cost of equity.
Who did the DCF? Did you do it?
I
If-
hope we did it.
If you did it, then of course you know what you did, right? So you can say, look, I've already built the cash flows, it's the margins. Be very careful though when somebody else has done a DCF. You know why? Because what do people often do in DCFs? They fix companies. They take low returns on capital and make them high. They make low margins and make them high margins. They take debt ratios and replace them with target debt ratios. If you do that, you're acting like you can change the way a company is run. Remember the Hormel valuation? In my basic DCF, I'm going to value it at 32, the status quo value. It's only if I think I can change it that I'm going to add a premium. So if you've done a DCF and your cash flows already reflect bad management, you don't have to attach a discount. If you assume that management will change, then you have to be more careful, because there you know you're being too optimistic, because this management might never change. So I'll give you an example. This was from a long time ago when it's a different time in markets. I valued a company called Tube Investments. Why did I value it? Because I know the people who run the company. It's from the city that I grew up in, and so they came to me and said, "Can you come in and value the company? Because we think we're being massively mispriced by the market." They felt the market was punishing them too much. Was trading at 4 times earnings. They said there must be something wrong. Can you do a valuation? So I came in and did the valuation. As I go through this valuation, I want you to kind of think about what the company is doing, think about the value of growth, think about cash flows, think about risk. So I took the company, and it's a profitable company. It's making money. It's reinvesting a lot. In fact, last year it reinvested about 113%. But looking back over time, its reinvestment rate is about 60%. Why they're reinvesting? Because they're trying to grow. The return on capital they're earning as a company is about 9.2% in Indian rupee terms. And this is 2003, 2004, maybe 2005 Indian rupee terms. You take 60% times 9, their growth rate is not bad, right? 5.5% in Indian rupee terms. So I plugged the numbers in: 60% reinvestment rate, 9.2% return on capital. Looks like they're growing. And the value that I got was 62 rupees per share. They were trading at, I think, 102 rupees. So I finished the valuation and I said, "You think the market's being unfair to you? I think it's actually being too optimistic. I think you should really be trading at 62. They were shocked. I mean, they were expecting me to say your value is 150, the market's growing up. So they said, "But no, we're growing well, 5.5%. Why is our value so low?" So tell them what it is about their growth that is driving their value down. What's happening? What's the return on capital they're earning on the new projects? 9.2%. Look at their cost of capital. This was a time when the Indian rupee risk-free rate was 12%. The return on cost of capital was 16.9%. They're growing, but they're growing by taking projects that are earning about 7.7% less than their cost of capital. So I tried to explain it to them. I don't think they quite got it, because one of the managers piped up and he said, "Hey, we could reinvest more. What if we reinvested 80%? So I went along. I tried an 80% reinvestment rate. Guess what happened to the value per share?
Fell even more.
It fell even more to 53. They said, "What if we reinvested everything?" And at some point they got it that reinvesting more and growing faster was not the answer. So what's the answer? What do they need to do? they need to take better projects. You can't keep growing. If growth here is not creating value, they have to earn a high return. The problem is they've locked their capital in projects where it's going to be very difficult to raise that return on capital. And they were in businesses that were fundamentally bad businesses. So I took one small step towards sanity. I said, okay, instead of 9.2%, let's say you can make 12.2%. You're still earning less than the cost of capital, but perhaps a little better in terms of project choice. The value goes up to 84. If that becomes 16.9%, if they can take zero net present value projects, forget about positive net present value, this value increases to 150 rupees per share. In fact, if they can fix their existing projects as well, which is even more difficult to do than taking new projects which are good, then the value can actually shoot through whatever the market price is. The lesson I hope I left with them was they were so focused on growth. They thought growing faster would make the market happier, that they kept acquiring and taking projects to grow, not factoring in the reality that growth can destroy value if your return on capital is less than the cost of capital. In fact, my original valuation of Tube Investments, I let the return on capital stay at 9.2% forever. This is insanity, right? Not only are they taking bad projects for the next 5 years, they're taking bad projects forever. And you say, why are you doing that? Tube Investments is run by a family, a well-regarded business family, but it's a family that controls the company. There is no corporate governance. So in my original valuation, that's how I reflected the fact that corporate governance is weak, is I said, look, they're taking bad projects. They think they're okay. They're in denial. They're not going to change, and there can be no external force that can be put on them. My value reflects it. So when I talk about your DCF value already reflecting corporate governance, it shows up in the assumptions you made about cash flows and growth and debt ratios. And if you assume management is going to change and you really have no power to change the management, you might be too optimistic in the value that you attach to the company. Any questions? Perry, you have a question, or your mic just open?
No questions, no.
Rami? Okay. So one final piece and then we'll end for the day. Cross holdings are a problem everywhere. It's not just emerging market companies, but some emerging market companies, they're front and center. So I've kind of talked about the difficulty of having cross holdings, right? Whether it's minority holdings or majority holdings and all the pains that come with it. So a few years ago, I actually did a few evaluations for the Tata Group. They were interested in the values of the company. And I valued 4 Tata companies. Don't even try to read the slides, it's impossible to read. But Tata Chemicals, Tata Motors, Tata Steel, and TCS. 4 companies, all part of the same group. I did a traditional DCF valuation. So you can go through the details, nothing really new here. I do exactly what I do with any company. I take the reinvestment, I take the return on capital, I come up with the value per share, but then I tie up loose ends. I add cash, cross holdings. So the other NO that you see here is the value of the cross holdings. Now I know it's tough to see in this graph, but here's what I found when I valued these companies. When I valued Tata Chemicals, when I discounted my free cash flow of the firm to the cost of capital, the blue portion is just my intrinsic valuation. The red is the value of the cross holdings. In the case of Tata Chemicals and Tata Steel, about half the value of the company came from their cross holdings. With Tata Motors, about 37% of the value came from cross holdings. With TCS, only about 5% of the value came from cross holdings. What does that tell me? First, TCS, I feel much more comfortable with my TCS valuation than the others because those cross holdings I'm really not valuing. I'm trusting the accountants and perhaps applying a price to book ratio to kind of finesse it, but a lot of the value is basically unknown. But here's my question. Why is such a small percentage? How do you explain the difference in how much of the value comes from cross holdings across? They're all Tata companies. So why does TCS get such a small percentage of its value from cross holdings, whereas the other 3 companies get a much bigger portion? Anybody want to give it a shot? It's the most valuable company, but even if it had been the least valuable company, it's still been a much smaller portion. Manit said it's the most valuable. It is the most valuable, but that's just indirectly the reason. There's a much more direct reason.
Chemical, steel, and motors are like production companies, so they have production assets across the world. and TCS produces services.
But why? How would that create cross?
in India.
But having production assets around the world doesn't create cross holdings, right? Those are cross holdings. Tata Motors is cross holdings in Tata Steel, Tata Chemicals, Tata whatever.
Oh, got it.
So how do you get cross holdings in other companies?
When you give them loan,
I think you're getting closer. Which of these companies is the oldest Tata company?
I guess Tata Steel.
Tata Steel. Right? Do you see why age matters? Until about 40 years ago, these companies were all privately owned Tata companies. So when Tata Motors wanted to build a new factory and it didn't have enough money, you know what the Tata family did? They'd go to Tata Steel, which had a good year. They would take money out of Tata Steel and invest it in Tata Motors, and they did it all legally. And they gave Tata Steel a portion of Tata Motors equity, which they all owned anyway. It was all part of the family. So the older companies, the cross holdings reflect their history, which is for a long time, they had a capital market within the family group. And those shares reflect that. TCS is the youngest of these companies. And in fact, it didn't even get created till most of the other companies had already become public. So part of this is just history. So when you look at the Samsung group, you will also notice the same kind of difference across the Samsung companies. Older companies, especially even within family groups, will have more cross-holding issues than younger companies. So I'll leave you with that because we're at the end of the session. Any last questions? Because we do have office hours tomorrow in case you have any questions about the quiz. And I'm going to try to have an extra office hour on Sunday so that if you have questions that come up later, you can ask me. No?
Sure.
Go ahead.
The one about the sort of a business with incrementally increasing marginal returns on capital, like a Rolls-Royce, an engine company, or even a ship company, like well, Carnival not today, but Carnival, let's say a year ago, they were going in this turn crisis. How would you use that formula then? Would you each year?
You'd have to do, if your return on capital is changing over time, don't use that equation at all. Use start with the sales, project out the margins, do the sales to capital. Always go back to the most general approach whenever there are changing returns on capital over time.
Okay.
Yeah.
Thank you.
If you're valuing a company which has like 30% of the value coming from a cross-holding, should you value that one company as well?
Yeah. And let me make it specific. If you're valuing SoftBank, you know who you have to value to decide whether to invest in SoftBank?
Oyo and WeWork?
No, it's Alibaba. 25% of SoftBank's value comes from holdings it has in Alibaba. So there's no way around it. No, so that's absolutely right. So when you're valuing a company where a big chunk comes from luckily for you, Alibaba is public. You can get the financials. Thank God it's not Oyo. You know why, right? Because there's no way you can even value Oyo even if you wanted to. The financials are not public. Any other questions? Okay, so I'm going to stop and I will send you some information about the quiz and specifics, and I'll see you at office hours if you have any question tomorrow, and we'll go from there. Take care.